It's the fall of 2021, and Mike Green of Simplify Asset Management is interviewing David Einhorn, famed value investor and short seller. They conclude a discussion of America Online's impact on investor psychology during the late 90s tech bubble, with Green attempting to pivot to the present by drawing a parallel with Tesla. Einhorn quickly objects, and in just over a minute, captures a decade's worth of investing narrative. Listen.
The poster child for that today obviously would be Tesla, right?
No, it would be Amazon.
Amazon, really? Interesting.
Sure.
Explain what you mean by that.
The poster child would be Amazon, but Amazon was a company that had no margin, and it had no real prospect of margin, and they seemed to be like the change bank and making up for no margin with lots and lots of volume. And eventually their web service business kind of worked for them, and then they added on advertising, and now you can see that it's turned out to be a very profitable thing. And so the benefit of the doubt to every company now, which is not profitable, but it has the hopes to maybe evolve its business, maybe its current business strategy makes no sense, but hey, maybe they'll develop Amazon Web Services, or maybe they'll turn into an advertising stream or something like that they don't presently have. There's a hope that, well, someday when they achieve scale, they'll find a way to make profits. And so there's all kinds of companies right now that are given that benefit of the doubt.
Fascinating. I mean, I love that observation, because I think you're absolutely right. I mean, you hear that on a continuous basis. I hadn't thought of it in those terms, but you hear that on a continuous basis, right? Amazon, et cetera, right?
But Amazon, no tree grows to the sky, is one of the most important proverbs on Wall Street. But Amazon, an exception that everyone who came after believed disproved the rule, a mantra that had its reckoning in 2022. A little bit of history on Amazon to flesh out Einhorn's thesis. Jeff Bezos created Amazon in 1994 to take advantage of the exponential growth of the internet. First they sold books, then CDs and movies, and soon, pretty much everything. Investors in the company made a killing as the stock IPO'd at the perfect time, catching the momentum of what would become the dot-com bubble. When the bubble burst, the stock collapsed, famously falling 94% from peak to trough. This didn't mean the business was in trouble though. Sales continued to grow through that period pretty much uninterrupted. Well, let's be careful here. Amazon was never really in trouble, but for a time there was a perception that they might be. Things got bad enough that in 2001 they had to publicly deny rumors that they were going bankrupt. If you knew one thing about Amazon during this time and the subsequent decade, it was that they were an online retailer where you could go to buy anything. If you knew a second thing, it was that they could barely turn a profit. The level and persistence of their unprofitability was breathtaking given the relentless growth of their revenue, even through the 2008 financial crisis. Bezos wasn't concerned though. As he saw it, leaving potential profits on the table was investing in Amazon's customers. He elaborated in his 2012 letter to investors. Take a long-term view, and the interests of customers and shareholders align. This was in response to a remark by journalist Matthew Iglesias that Amazon, as best I can tell, is a charitable organization being run by elements of the investment community for the benefit of customers. In the end, Bezos turned out to be right. After squeaking out an annual gain in 2015, the profits started following the trend that the revenue had established. Bezos even did a stint as the world's wealthiest person. Now, let's go back to Iglesias. Notably, not a bear, just a journalist fascinated by the business model. He had more to say about the company a year after his charity remarks. He wrote, "What makes Amazon not just amazing, but downright dangerous is that as a financial matter, it has something even better than profits, the boundless faith of the investment community. Wall Street treats it like a brand new startup that just needs to think about growth and can find a viable business model later." And here's where we pivot. Amazon took 20 years to consistently generate a profit, and yet somehow its model became the aspirational one for multiple generations of startups. Not Facebook, which when it IPO'd in 2012, filed an S1 showing a profit of $1 billion. Not Google, which was profitable practically from inception and earned over $100 million in 2003 before it went public. Amazon became the model because profits are hard, but what's even harder is for an investor to discern whether a company is choosing to forego profits in favor of growth or whether a company has no choice but to grow and hope that lightning strikes. If a person knows one thing about Amazon today, it's that they're an online retailer where you can go to buy anything. If they know a second thing, it's probably that Prime offers free delivery. Then maybe that Bezos got divorced and got jacked. You probably have to get pretty deep into the list before someone from outside of the tech or financial industry mentions Amazon Web Services. In 2006, though, lightning struck for Amazon. Started by a team including Bezos himself and current Amazon CEO Andy Jassy, AWS began as something no one really understood. Even 3 years later, a headline from the Wall Street Journal was, "The internet industry is on a cloud," whatever that may mean. But the potential was big. Bezos declared in his 2014 shareholder letter, "I believe AWS is market size unconstrained," and he was only barely exaggerating. Today, Amazon Web Services is responsible for about 3/4 of the company's operating profit and nearly all of the growth within that metric. Realistically, Amazon, without AWS, would just have become an annoying competitor to Walmart. But Amazon, it should be a mindset that exposes the speaker. Nevertheless, a 2019 TechCrunch article titled "Unicorns Aren't Profitable and Wall Street Doesn't Care" begins, "In Silicon Valley, investors don't expect their portfolio companies to be profitable. Blitzscaling, the lightning-fast path to building massively valuable companies, a Bible for founders, instead calls for heavy spending on growth to scale in an Amazon-like fashion." Let's see how this plan can look in practice. In 2017, Helios and Matheson Analytics acquired MoviePass, a movie ticket subscription service. They slashed prices and growth exploded. You could go to a movie every day for $10 a month. Moviegoers love this service. In many cities, a single ticket was already nearly $10. The service was shut down a year later, its parent company insolvent. The plan for profitability had involved vague references to using data for advertising and getting a percentage of concession sales. It was never going to work. Remember Iglesias' remark about Amazon being a charitable organization? Venture capital gave billions to startups and told them to grow. They quickly learned the best way to do this was to give away dollar bills for 50 cents. Have you taken an Uber, bought a meal kit, or had a razor delivered to your house? If you ran a business, did you pay for payment processing and data analytics and whatever it is Fastly does? Congratulations, someone in Silicon Valley chipped in to help pay for that. The only way to fail in startup land is to run out of money. If you had profits but low growth, you might have to rely on your own money. But if you were growing, you could get it from somebody else. The cost benefit is easy. Show me the incentives and I'll show you the outcome, Charlie Munger is fond of saying. But Amazon, what happens to a company when they go to refill their bank account 2 years into a 5-year growth plan and the well has gone dry? You're a sports betting site that only knows how to give away promo codes, or a car vending machine company that pays above market for inventory. In 2022, someone turns on the lights at last call and that line you've been saying about being unprofitable but by choice is about to be tested. Do your customers value your product, or were they just there for the arbitrage? Can you conjure a lightning strike? Share price is a knife that's falling. It's down 90%, but Amazon was down 94%, you tell yourself. The infection spreads from the entrepreneur to the investor. In 2001, not long after Amazon had to deny the bankruptcy rumor, Fortune magazine writes an article that concludes, "Bezos' Amazon is a land of eternal hope. There is a chance that someday Amazon will grow up to be a company with real profits, but it will never be the high-growth, wildly profitable, super-efficient company of internet lore. The only place that company lives is in the history books and in the powerful imagination of Jeff Bezos. The author could not have been more wrong about Amazon, but was exactly correct about the land of eternal hope. Thanks for watching, guys.